All right. So again, happy Hari Raya to all who celebrates or celebrate with friends. Whether you're Malay, Muslim, or non-Muslim or non-Malay. Yeah. So happy Hari Raya to all. Unfortunate because this is a big celebration in the Middle East, uh, and given the conflict and the war in the region now, I would say I saw some news report that say it's a very quiet Hari Raya this year. Quite unfortunate. But let's hope it's not too many casualties in the war. Okay. And we'll come back to this also during our discussion of today's lecture. Right. So what are we covering today? So today's lecture, we're going to cover two things. First, we'll talk about the lecture slides, right? And I believe these will take up about maybe 2 hours of our time. And then we'll have around 1 hour or 45 minutes thereabouts to answer any questions you might have regarding the ECA or the class test, right? So I hope all of you all know that the class test will be next week, next Saturday, and the ECA questions have been released, right? I believe some of you all might have questions. I received some emails already, so feel free to use this time where we can actually go through uh, any questions that might have and try to address your concerns. Right. So that's the plan for today. Um, Also on the side, in case you have downloaded slides long ago, do download the new set of slides. So I uploaded this new set of slides last weekend, right? So in case you have downloaded them long ago, do download the new ones. I just added one or two additional slides. And then before we start this, maybe for those who have already started looking at ECA, you know that this lecture, kind of actually on this topic is kind of actually not really tested for your assessment, and this is normally the case. Most of the time, this technical analysis topic, it's a bit tough to test, right? And since it's the ECA, which is like a take-home assignment, it's very hard for these kind of topics to be tested other than actually predicting the market movement using technical analysis. So while it is not tested, I think it will be interest to many of us who are, you know, or who are planning or already started doing some kind of investment. And typically, when we do investment, we use some version of technical analysis, and you'll find it very useful, especially if you have started doing some small investments or even large investments here and there on apps like Moomoo and Tiger, right? So hopefully, I can use some real life examples over the course of this lecture to kind of show you like, hey, can be actually quite interesting to use these concepts in your own personal investment. So I think this lecture is really more of to aid you in your own personal investment goals, right? And as you know, most of us, even when we invest, we do not invest using fundamental analysis, right? Meaning that we do not create like the GPA report that you have just submitted for every company and then try to value the company whether it's undervalued or overvalued, right? Typically, we use some form of technical analysis to help us do our investment. So this gives a good segue to what is technical analysis. So technical analysis basically is, let me just pull out my highlighter. So it basically is just looking at price movement, right? So in most cases, when we do our own personal investment, we do not really have the time to, let's say, draft a report like the GBA, right? And now that you have experienced one round of valuing a company, you know how long it takes. It's not just overnight thing. It takes maybe 1 week or at least, and 1 week with maybe a few of you, right? Four or five of you guys working on one file. So in most cases, we use technical analysis because it's kind of intuitive. We just look at price movement and then we try to anticipate what is the likely price movement over the next few days, whether the price will keep going up, keep going down, um, And then we use various, okay, so this technical analysis is linked to this Dow theory. You can read about it a bit more. And apparently, successfully signaled the market crash in 1929. I don't think any of us was born. I wasn't born as well. But the idea behind it, right? So this is quite interesting. What is the premise of doing technical analysis? It is based on strong assumptions, right? So what's important is not the price. Is the price change that is important, right? So at the start of today's lecture, uh, I mentioned this MSCI, right, stock. So MSCI is a semiconductor stock. If you go just to Google and type MSCI, you'll see that pre-market it has been falling a lot, right? So the price change is actually important for a technical analyst. And maybe, like I say, in your own personal investment, you might actually do some form of technical analysis, right? You see that, oh, the price falling, like, maybe it's a good time to buy, right? Then the question is, okay, if you just look at price reduction as a buy signal, maybe it could be a little rudimentary or like basic, right? Maybe you can look at some more interesting kind of way of analyzing the stock movement. So that's what we'll see just a bit, right? And the assumption behind just looking, or not just, but looking at these kind of trends and movement is the idea that market action discount, meaning the price movement discounts or take into account everything in the market, right? So imagine things like supply and demand, political situation, and in the MICI case, it's because of the findings of the court about their sales of these chips to China, and in particular the NVIDIA chips that were supposed to be restricted to be shipped sold to China, but they found that they actually through some shell companies and through their servers, because MSCI produce servers, through their servers which contain this chip, and these servers are being sold to China, right? So there's a big probe there, and three of the members, not members, but like top management, including the founder, was found guilty, right? So it's a big thing for the market because, first of all, the US government controls the chips that's flowing out, especially NVIDIA chips or AI related chips flowing in and out of the US, right? Because it's one of those I would say commodity that everyone wants to grab their hands on, right? So there's a competition between US and China, so they don't want China to have it, right? So if you're contraventing the regulations, government regulations, and obviously it's being found now, chances are it's going to be bad, right? Maybe the government will no longer award you contracts to manufacture AI related servers for them, right? And this kind of thing, there could be a lot of repercussions. So the market basically discount or take into account all this information, right? And this is one assumption that we have to assume. When it's kind of true, right? The market consider all these things, and that's why the stock price pre-market is falling almost 25%, which is I think the biggest it has fell in at least the last year, right? It has not gone, I think, below 30. So now I think it's somewhere trading around 25, which is very low. Okay. And of course, at its peak, it was 100. So that's a lot. And then the thing is, maybe using the same example, we, we can't assume that history will repeat itself, right? So the idea, okay, now the price is so low, maybe it's time to buy. Hopefully, the price will increase in a bit, or not a bit, but maybe a couple of months or a year, right? Because you feel that there could be some cycle that goes up and down, and eventually, the price should go up again because history can't repeat itself. So if you have that kind of idea, yeah, then maybe you want to buy this stock now because it's so low. Then again, if we take the idea of price movement in trends, right? If the price increase today from yesterday's level, chances are it will increase. So in the same line of thought, if the price is decreasing today pre-market, chances are at least it will continue decreasing for a short time or a bit more, right, before it start increasing. So maybe it is bad time to buy, maybe, right? Um, so then the last point is, you identify some of trend or trend emotion is likely to continue then reverse, right? So the falling trend is a higher chance for it to continue falling, right? Further assumptions is that trend tend to persist for a long time. So in the case of MSCI, also unfortunately the company stock price has been falling for the last year, right? Since its peak, I think somewhere in mid 2024. So it has been on a decreasing trend. Um, and the idea behind a good technical analysis is that we try to spot these kind of trends before other people spot these trends so that we can quickly invest and make a profit. There's this interesting comment here, right? Volume trade is important. Anyone wants to give a try and explain why is volume trade important for technical analysis? Okay, in what sense? What sense? Yes, you're right, but what sense of liquidity? More price movement. Yeah. So when there's high volume, the price is going to move more dramatically, harder to manipulate. Okay, I like the answer, harder to manipulate. The idea behind that comment is probably that there's some conviction, right? There's some conviction that the price is actually going up. Like the whole market thinks that the price is going up. So that's why it's more difficult to manipulate everyone to change their opinion that the price is going up. Yeah. So when there's some volume trade, why is it what you're trying to say is there's going to be a pull and push kind of relationship, right? There must be buyers and sellers obviously of the stock. So depending on the pressure, how much volume is being traded on the buyer and seller side, it will determine the price. So more volume means big money. So I guess I try to say like, is it more volume means that the change based on the quantum is bigger. Is it? Is that what you're trying to say? So it's like a $1 stock if you are buying and selling like 10,000 quantum versus 1,000, right? Then you are 10 times more. Okay. Yeah, so maybe you can think it that way, right? So based on the volume amount, um, it will push, like if you're selling or you're shorting big enough volume, then it can actually potentially push the the overall price in one direction, right? So yeah, volume trade is kind of provides meaning to the trading strategy, right? So when there's change in prices with very low volume, we know that the market is not so convicted to that particular direction. So what's interesting is sometimes, if you notice the market in December, you see that the market, right, is very flat. Like it's going up 2%, down 2%, 1%, 2%. It has no conviction in terms of the movement like what you see today in markets. If I'm just looking at my market monitor on my screen, like yesterday was so red, right? It was almost a red day with some green specks here and there. But yeah, there is no conviction in terms of like, okay, all the market participant is going to short or buy this kind of stock, right? So there's no conviction there, right? And so you notice this, especially during the holidays, Thanksgiving, Christmas period. And then, of course, out of that main period, we'll see that the trades are of high volume, right? So there's conviction in the trades. Any questions so far? So this one is just a bit more of a background and some kind of theory for you to understand. Um, okay, maybe not. Advantages. So like what I say, you normally use this really for your own personal investment because it's easy, it's quick, you do not uh need to use like look at financial statements and yeah, which is like takes a lot of time, right? Because doing a full fundamental analysis takes a lot of time. But not only that, the idea is that it will incorporate, all your psychological kind of biases, as well as real market reasons for price changes, right? And it tells you when to buy, not why you should buy, right? And when to buy is more important, right? Because we are focusing on price change. So why you buy is also important, so long as you see maybe a pattern, maybe or you see that it meets the technical criteria instead of thinking, okay, this is a bit maybe it's not the right time. Oh no, what if it continue going down? So instead of having this kind of thoughts like what if, right? Which is more psychological, cognitive kind of I would say stress or biases, you just follow the technical analysis charts or patterns, which we'll see later, and we just follow and execute the trade, and that's all. Yes, so you're right. I like that comment. So you're totally right. This method is short term. Short term can be 1 day or even less than 1 day, a couple of hours. Uh, and it can be, maybe even like 1 month, right? But we're not looking at like buying the stock for like 10 years using technical analysis. No. So we're not talking about 10 years, but we're talking about like, anything less than a year or even 2 years max, right? Right. So short term trading. Um, Disadvantage, I would say it's the ideal thing is really, do you believe in it, right? So some people don't believe in it. Like people that believe in efficient market feels that if the market is efficient, then you shouldn't have such pockets of time where you can actually do some like graphing and all and suddenly come up with uh, method to earn money that the market doesn't know, right? Because if the market is so efficient, it will have incorporated this technique that you have found to earn additional bits. So some people claim that if this really works and everyone uses it, the market would self-destruct, or maybe not the market, but the method of using technical analysis will self-destruct. What does it mean? It means that if everyone can use it, then it's as if no one will benefit from it, right? No one can use it. Uh, when you say high liquidity, what liquidity are you referring to? Uh, Generally that's the case, but there are also so obviously stocks that are actively traded, you will have more movement, right? And in technical analysis, again, what we're interested in is price changes. So with stock that is highly traded, then yeah, there's going to be a lot of movement, meaning that you can potentially earn quite a bit if the price move in your favor. Now, having said that, there are some stocks that tend not to move so much, but at the same time, you know, um, they maybe move in a particular direction, and because of that, you can use technical analysis to determine whether you should buy that particular stock now or later, right? Uh, some examples would be, normally like Singapore-based ETF that tracks a US market index. Let's just say something like this, right? And because it's a Singapore-based kind of ETF, the volume traded will be a lot lower. It will be less actively traded, notwithstanding that it is tracking, let's say, Dow Jones or something, right? And I think nowadays Dow Jones, not many people follow Dow Jones. So, to say that, okay, even though it is less actively traded, there could be still fluctuation, just that you don't see high volumes, right? So in terms of price movement, there's primary, secondary, and ripple, right? So there are a lot of words here explaining to you, but I think how I like to see is just looking at this graph here, right? So let's just look at a graph. You can read through that whole chunk of words, but the idea is quite simple, right? Primary trend. What's primary trend? The primary trend, right, is what the price of the stock is moving towards, right? And you can see that in the long term, the price of stock is just going downwards like this, right? So this is the primary trend of the stock. Now, we have some secondary trend that's happening here, right? We have some secondary trend where he can, at this point, can you see it's increasing? I mean, at this point, it's increasing, at this point, it's increasing. Notwithstanding that, at the end of the day, the increase in, let's say, 1, 2, and 3, the increase in 3, so the increase in 3 is still lower than the increase in, let's say, 2, right? Because the primary trend is still down, but there's some secondary increase here and there. Then we have this thing called ripples, right? So ripples are minor fluctuation that happens daily. So your ripples could be things like this, right? See, like this thing going up, 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 down, down, down. So like this very small kind of trends that happen. These are your ripples. So this chart, like what it describes to you, it says that there's a primary negative trend, so it's going down, right? However, there are some positive, secondary trend like what we mentioned, some going up as well. And because when I mentioned number three, see number three here, the increase is lower than number two, it means that overall it's still on the downward trend. Right? Overall, number three is less than number two, means that it's still a bearish kind of signal. Now, in terms of technical analysis, when we look at such patterns, we kind of assume that this pattern persists for a long time, right? But sometimes, and we'll see that in a little bit, that there could be some reversal kind of trends, right? The price reversing. So we'll look at some reversal patterns as well. But in most cases, when we think about um, movement in prices, the underlying assumption is that okay, you continue in that direction. Okay, so this is an example to show you, the increase in price, and also show you that okay, whenever there's a dip, maybe it's a good time to buy, and then you sell here and you sell here, right? Of course, looking at this graph, it looks very common sense, right? To okay, I need to buy at this point in time, I need to buy at this point in time, buy at this point in time. But you need to remember, right? This is like historical, right? So there's this saying, right? Like hindsight is 2020. Like when you look at all the price movement, you really know that okay, this is the right time to buy. But the question is, maybe at this point, right? Let's say you are standing here and this is today, right? Hey, it has gone up a lot since the bottom here, right? But do you know whether you'll continue going up to this point? You do not, right? Imagine you're here today, you do not know. And so that is the toughest part of technical analysis, because whenever we study technical analysis as like a theory, which is what we're doing now, we see the entire trend, right? So it's like, oh, it makes so common sense. We should only sell at this point here, right? But in real life, when you're standing at this point here, you wouldn't know at all whether you go up. So that's the tough part of technical analysis. Okay, let's cover some, quite simple, I'd say, charts first, right? So not really technical analysis, but just looking at some price movement chart. So in terms of line chart, this is the simplest kind of charts where it's just tracking the movement in prices of the stock, right? The price go up, price go down, and that's all. Yeah, it doesn't provide any other information other than this. And the chance of you using this is very slim because nowadays there's more sophisticated kind of charts like the bar chart, which is also not so common nowadays, right? So let's try to understand how the bar chart works. So I'll just zoom into this point here. So the bar chart, it works like this. The bar chart has a high and low price, the highest and lowest price, and this is given by the top and the bottom, right? Highest and lowest. This one a bit easy. Now, the opening price is always on the left. The left is opening, and the right point here is the closing price. Right? So that's how we look at the bar chart. So the question here, let's say I want to look at, okay, let's say I will look at this one here, right? This particular line. Is the closing price higher or the opening price is higher? So I'm looking at this line. Yeah? Is the closing price higher or the opening price is higher? Okay. Closing price is higher, right? I hope you can see closing price because opening price is always on the left, right? So opening price is this, and the closing price is this one here, right? So closing price is higher. Yeah, right. So what about this one here? Let's say this line here. What is the closing price higher or the opening price is higher? Opening is higher, right? So opening it starts at this point here. Yeah, right. So that's how you read this, right? So opening price higher meaning what? There is a decrease, a decrease in price. This one is an increase in price, right? Decrease, decrease and increase, right? So that's how you read this graph. But I would say that maybe it takes a while. It's not to get familiar with like this kind of line, but it's not so easy to see quickly, which is why this is not so common as well. And the candlestick chart perhaps is the most common chart being used in most softwares or even your own personal investment, right? On Momo or uh, Tiger brokers. And how do we read this? So first of all, whether the top and bottom point is just the highest and lowest. Now, the candlestick doesn't differentiate the left and right like what the bar chart does, but it just tells you the color, right? So long as it's green, means the price is going up. So long as red, means the price is going down. Then you have your opening and close, which is given by the rectangle shape. So this makes it a bit easier. So you know that whenever it's red, the price is going down, whenever it's green, is going up. So can have a look at here, right? So we see that the prices are going up, 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 and then down. There's a bit of up here, up, sorry, up here, and so there's a disconnect, right? So what happens is that overnight it just jump all the way up and then it drop. It start going down again, right? So there's a slight something must have happened here for it to jump all the way up. Maybe if you think of it, if this graph is oil, it could be the Iran war started, right? Then it jumped all the way up. And then people realize, okay, maybe as of today, this point here, the war is not so bad. That's why the price went down again. Let's jump too high. So that's how you can see this. Do we have any questions? No? Okay. Then, if no questions, let's go into the actual technical analysis per se, right? Um, and the first one we're going to talk about is moving averages. And you see this in your platform like Mumu or Tiger as MA, right? So you see MA is moving average. And the idea of moving average, I'd say, is the most basic technical indicator, right? And we really need to understand this because the next few technical indicators that we're going to talk about, we're going to build on to the moving average concept, right? So to understand moving average is important. Now, let's take a step back, right? So let's try to understand what's moving averages. Okay, so in layman terms, in most simple terms, right, is this, right? So before we look at all these words, the a moving average, right, is basically trying to smooth the line. So imagine this, right? Imagine the price of a stock goes like this, up, down, 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 up, like it's a bit funny to go like this, maybe like this. Yeah. Okay, so this is a bit exaggerated, right? So basically it's like a ugly line like this, right? It will never go like this because this is not even the price movement. Now, in a moving average basically either to smooth the curve. So instead of this weird shape, it's a bit smoother like this, right? So instead of like all the jagged, it's like the smooth, right? So that's where the name comes from. Moving, which is price movement, averages, right? When you average something, it becomes more, it becomes closer to the mean, right? It's become less volatile per day basis, right? It's been smoothed out because it's averaging it. So that's how the name come about. Moving, which means price movement, and averages. So what it does, right? Let's look at the words here now. We know that all these jagged point is basically noise, right? They're random volatile movement. And the idea about moving average is that I just want to filter out all the noise and really isolate where or how the price is moving, right? Is it going down like this and up, etc. Right? So that's the idea of moving average. You just want to remove the noise, smooth the curve so that we can see where the price movement is really coming from. Okay. So the 20-day moving average is a common benchmark being used uh, to compare the moving average with the price. So when you have, let's say, a price curve and a moving average curve, let's say the price is above the moving average, i.e., cuts the moving average from below. So let's say you have a moving average curve like this, right? And let's say the price goes very, oops, I should just use this. It goes like this and it cuts. So when it cuts the moving average, the actual price cuts the moving average curve from, it means that this is a bullish breakout. So it's going to, after it breaks out from here, it's going to go upwards already, right? So it's a bullish breakout. Now, if it's going to cut from the price is going to cut from the top to the bottom, cut from the top bottom, it signals a bearish breakout, meaning that it's going to fall after this, right? So this is how we use the moving average curve in a simple sense, right? So we have a very smooth line and we have the actual price, right? And so then we can determine when is the bullish or bearish breakout. So let's have a look here. So let's look at this. Okay, so we have the price movement, which is very ugly like this, very ugly like what we talked about, like zigzag. And then we have a moving average, which is very nice, right? Like a smooth curve like this. So what's happening here is that, can you see that when the actual price cuts the moving average from below up. So at this point, this is a buy, right? Based on the concept of moving average. Because when it cuts from the bottom, it's going to be a bullish breakout. So, and it makes sense because if you buy here, can you see this, the subsequent day, you're going to gain so much. Now, having said that, it cuts, if the price cuts the moving average from top down, can you see that after this, the price actually deteriorate quite a bit, right? So this is a way to kind of signal when to buy and when to sell, right? So when it cuts like this, you are going to start selling the stock because it's cut the line from top down. Of course, again, the issue with technical analysis is this, right? It's easy for you to like, okay, we see this curve that is historical that is there, and we have identified a trend. But let's just say, I'm just going to zoom it here. It's a bit pixelated, but it's fine. Let's just say I'm at this point here, right? Oh, sorry. At this point here, where my price has cut, almost cut at this point, cut the, okay, so let me just erase all this so you can see that it actually is cutting. It has already cut the line, right? The moving average line. Then you think, hey, you know what? It's going to go up already. But then the next day, what happens? It went down. So, so at that point in time, you might be worried that, oh no, they are doing wrongly, right? And the thing is, you wouldn't know until much later here, right? When it really cuts and go all the way up. So what I'm trying to say here is that it might be easy to look at this as like, okay, I know where to buy, when to sell. But always put yourself in a position that when you're actually doing such technical analysis and doing such trade, you are always at a point of time where you have no other information other than the past information. Yes, yeah, right. Which is why we can see when to buy before the actual price actually go up. Yeah, that's how moving averages work. And because it averages the price, so then it becomes slower, right? Um, Now let's look think about it in more mathematical sense. Okay, let's see the question. Which time period will you say is will be accurate? Well, okay, so it depends, right? Like what we saw earlier, they say 20 days is normally a common benchmark. But it really depends. This is where trading strategy come in, right? Some analysts would say, oh, you know what, I always use a 25 or 22, right? And it always worked for them. So every analyst would have their own, say, trading strategy. And I like to highlight this also, right? That even if you go to, let's say, now this is very common, you go to those investment seminars where you actually pay quite a bit, and then the guru will kind of teach you how to do investment, right? I think some of you have seen this before, right? Now, I like the question and say what period should you use. So what period you use, right? It really depends on your own personal investment strategy. Even though let's say a guru tell you, okay, you should always use 20 days. This is a perfect benchmark. But remember, when you are doing the trade on that day itself, right? Let's say you're doing the trade the day itself, there's going to be a lot of emotions that's going to come into play. Like let's say here, a lot of emotions come into play. Or is this a real signal? And every individual, you, me, your friend, your neighbor, will all have different emotional and psychological threshold or biases, right? And so even though let's say you follow to a textbook from this trading guru that okay, you use this technique, whenever this happen, you should do this. But remember that at that point of time when you really need to execute that trade, your emotions will come in, right? And how you react compared to how that guru react, compared to how I react is totally different. And therefore, that hesitation, that maybe more aggressive kind of behavior to buy instead of to wait would determine or would drastically change the amount of return you get, right? Which is why, I always like to say that whenever you do technical analysis or if you're hoping to focus on technical analysis in your investment, the best investment strategy is the one that you created yourself, meaning that you use a small amount of money, you slowly learn about your own personal, it's almost like a journey, right? It's about learning about your own personal psychological biases and as well as if you have any barriers, etc. Right? The best investment strategy is the one you create. That's how people typically traders or say personal traders become I would say rich, right? Or make very good investment decisions because they come up with the strategy themselves. They did not wholesale take a strategy from someone else simply because there's a lot of emotion involved when you're trading and everyone's emotion is different, right? So hopefully answer that question, but a bit long-winded. But then the idea behind this, right? What is simple average, simple moving average? So simple moving average, right? Basically, it's just an average. Okay, it's just an average. And in this average, we are going to assign equal weight to every data point. And we'll see this in the next slide where we have an example to show you. Now, we have a P interval moving average. P meaning it can be a 3-day, 4-day, and then we just find the average based on that number of days, right? There is a limitation to this simple moving average where there might be a lag behind the current market price because it does not prioritize recent price action. So we'll look at this point. This point is quite interesting. We'll look at it in a little bit after we look at the example we have on hand. So let's look at a very simple example. We have a closing price of for 4 days of this particular stock, right? So the first question is this. We want to calculate the simple moving average for day 3 using a 3-period simple moving average, right? So we want to calculate what's the simple moving average for day 3 here, right? Using a 3-period one. So how do you determine a 3-period? We simply take 10 plus 12 plus 11, right? 3 data points, and we divide by 3 because it's a 3-period simple moving average. So it's a simple average, right? So then, therefore, the 3-day simple moving average is $11. That's all. Very simple, right? It's just averaging. Now, calculate the simple moving average for day 4 using the 3 days period. So now, instead of the first 3 number, we take the next 3 number here, like this chunk of number 12, 11, 13. Then we divide by 3 to give you the day 4 3-period simple moving average. Do we have any questions for this calculation? Any comments? Right? None. So do you notice something about this? Do you notice that there's equal weight placed on the 10, 12, and 11, notwithstanding that 11, let's just say, is the latest price, right? And you think about logically, shouldn't the price that is most recent, that means let's say today is day 3, right? Shouldn't this price of $11 have more meaning to you in terms of what will happen next, right? So in this question, you only have 3 days, right? Imagine you are doing a 20-day, like what the previous slide was saying, that 20 days is a good benchmark, right? Let's say we do a 20-day simple moving average. Do you think that the day 20th, which is all the way at the back, 20 days, which is about 2 weeks ago, is going to dictate your price now? And why I ask you that question is it's very interesting, right? Earlier in the today's when we first had the introduction, or not even introduction, we just started lecture, and then when somebody say that 2 weeks ago the market was totally different, right? It was totally different from what we were today, right? That's just 2 weeks ago. 2 weeks ago is almost 20 days, right? So if you think about it this way, imagine you use a simple moving average of oil price 20 days, right? Your 20 days oil price during our last lecture is so low compared to now, I think it's more than 50% higher. So then you realize that, hey, you know what? Actually, using average of fixed average doesn't make sense, right? Which is one of the biggest limitation that you are giving equal weights to every data point. But shouldn't the 20th data point all the way at the back, which is our last lecture, worth less to you? Because what's happening now in the market because of the war today makes more value compared to what is happening 20 days ago when there's no war. Does that make sense? So I hope you can see that it may this simple moving average, because it does not prioritize your latest data point, there's some lag behind what is actually the current market value. No, so I don't think there is. Maybe you ask Gemini, you can check. I don't think there is because it's just simple moving average, right? It's simple. It's just an average. Um, but you might want to check because I've never tried that before. Maybe you can check with Gemini whether there is such a thing, or somebody that has it open or ChatGPT in front of you, you can double check. But I do not think so because it's just average. That's all. Now, having said that, uh, I just want to highlight for you that this calculation you will never be asked to do it because if you are a trader, you have Bloomberg, you have Refinitiv, everything is done for you, right? You just click a button, that simple moving average line appears on your screen, right? So you'll never be asked to calculate it. But the idea of why we look at this calculation, okay, is to really understand what does it really mean. Because sometimes you just, when you click a button on Bloomberg and ta-da, the line appears, this beautiful line. And then you're like, what's this line? Like, what does it even mean? And then maybe people say, oh, no, once the line, once the price cut the line from the bottom up, then it's dangerous, right? Oh, no, sorry, dangerous. It's good to buy. When you cut it from the top to the bottom, good to sell, right? But then what does it really mean? So that's why we look at examples. Of course, for those who are doing your CFA, you'll be asked to do some kind of simple calculations, right? Because they really want to test your understanding. Yeah, you're right. So it's quite common that there are some limitations in terms of especially things like black swan event, like the Iran war is a black swan event, right? There will be some form of limitation in that sense. However, I would say the fundamental analysis has even bigger limitations because we are looking way back, right? We are doing long-term investment, not compared to things like simple moving average, which we typically use for trading. So it's supposed to be a daily thing, right? Or like what I said, it can be 1 month, 2 months, maybe 1 year can be a short term, but that's stretching it a bit already because you can see how 2 weeks change the market so much. So it depends, right? How you think about it. Okay. Okay, maybe before we go to exponential, I know it's a bit early, but let's take a break now. We come back around 8:05 and then we do exponential moving average, right? Because this one is quite a bit to talk about and then we'll talk about it. Okay, so let's take a short break. And as usual, we try to do two breaks and then we can come back again. Okay. All right, welcome. How's everyone doing? Okay. Okay. Uh, okay. So let's continue. So, good. They're doing great. Now exponential moving average. So just before the break, we are talking about simple moving average, right? Which is just simple, right? Just averaging. Now, remember the limitation that we talked about is that, hey, you know what? You are not placing enough emphasis on the latest price, right? We should be placing more emphasis on latest price, right? And so the exponential moving average is here to now correct this issue, right? To give more weight to the most recent price. And how do we do this correction, meaning address the lag, is to provide more weight in the most recent price so that when you do so, it creates this exponential moving average curve that is going to hug the price even closer, right? Meaning what? Meaning that, let's just look at the previous slide. It means that if this is exponential, let me just see, is it exponential? Okay, they didn't say it's exponential or what. But then let's just say this is the simple, right? Simple moving average. This is exponential. Let's assume. So can you see that if this exponential, it actually is closer to the actual movement of the price. So that's the idea of exponential moving average. It hugs the curve, the actual price much closer. Okay, and how do we do this? We do this by weighing the price using an exponential function, which is what I call exponential moving average. And this is the exponential function here. Sorry, not the PJ. PJ is price, right? So exponential function is the one with the E. So this formula looks a bit scary, right? But let's try to dissect these together. Okay, so PJ is the price, right? Price at all, yeah, period of time. Now, we have a weight factor, which is the exponential function that we talk about, trying to weigh and give more weight to the most recent price, right? And this exponential function looks a bit scary, right? Why is it this I minus j divided by p, right? So remember that when we do a moving average, right, adding up all the individual price and then we averaging it, right? So in this same sense, we need to add. So that's why there's a summation. There's a summation function here. So we're adding all the prices, but now that is being weighed by exponential function. So we're going to sum all this and in the end divide by the sum also, right? Divide by the number, right? In that case. So how does this weighing function work? So the weighing function works like this, right? As you go further back in time, remember how exponential moving average simple moving average works, right? If a 20-day moving average means you have the price now, and you keep on going back until day 20, all the way back day 20, right? So in this generic form of exponential moving average, we are going to go back all the way to negative infinity. So this is the generic form, right? So if we can actually go back to negative infinity, that's the best, right? Because we capture every single data point until negative infinity. Everyone understands this? So this is an important concept. So maybe I just repeat one more time, right? So we recall that in a moving average, let's say a 20-day moving average, we only look at 20 days, right? We just go back until 20 days, day 20, and that's the last point that we're going to use. Now, in the exponential moving average, in the theoretical form, the best case is that we can go back all the way to negative infinity so that we can capture all the data there, right? And then we weigh them based on the exponential function. When we go all the way to negative infinity, means what? It means your J is going to get more and more negative, right? So it'll be -1, -2, -3, -4, right? So it gets more and more negative. As your J gets more negative, your negative J gets more positive, right? So your J gets more negative, your negative J gets more positive. So your minus I minus j, this one here, gets more negative because there's a minus there, right? You multiply by minus, so it gets more negative. Now, an exponential of a more negative number gives you a smaller value. So in this sense, as you go more and more big, right? Minus 1, minus 2, minus 3, minus 100. Your minus 100 exponential of it, the e to the power of this negative 100, is going to be a very small value. Hence, this value there, the price at negative 100, is going to play a very tiny role in your exponential moving average compared to, say, day one. Does this make sense to everybody? This concept of exponential weighing. So, of course, it's very theoretical to say that it can go back negative infinity, right? In it's almost impossible to do that, right? Maybe you're a supercomputer. If now start investing in quantum computing, maybe you can do that, right? You create a quantum computer that goes back to negative infinity. But the chances are, what you're going to do is this: you're going to apply this 2p rule, right? And the 2p rule is not complex in the sense that, let's say you have a 10-day exponential moving average, the maximum you need is just to 20 days, two P's, right? Two P's, that's all. That's the maximum that you need to go back to, right? So you just need to go back 20 days, and that's enough because your smoothing function or your weighing function or weighing factor at day 20 is going to be so small that your price movement on day 21, one extra day later, is just going to affect your exponential moving average by so tiny that it's not going to be that material. All right. Everyone understand the concept of this exponential moving average? Okay. So let's look like let's take an example here, right? This example, you look at it, it's like, it's a bit different from what we're talking about, right? Where's my E and everything? So let's try to understand this. So working with an exponential function can be quite complex, right? And you probably learn in secondary school, or I think you definitely will learn in secondary school, Sec 4, Sec 5, that period of time, you will learn that there's a simple way of estimating exponential function. And that is by plotting a 1 divided by n function, right? 1 divided by n function, which is going to give you a similar payoff as an exponential function, which is what we see here, right? So instead of exponential function, what I'm going to do now is I'm going to take this 2 divided by n plus 1, where n is the number of days of the exponential moving average that you want, right? So it's number of days of exponential moving average. So let's say the 3 days exponential moving average, we put a 3 here, right? And so this zero, if let's say it's a 3 day, this 0.5 is now the weighing factor, right? So instead of that e to the power of negative I minus j, negative, yeah, negative bracket I minus j, instead of that very busy mathematic formula, we just use an approximation of 2 divided by n minus plus 1. Right? Then the thing is, we can see, let's test whether it works, right? Imagine your n is a very small number. Meaning what? Meaning your k is going to be very big, right? Meaning that your most recent number, because n is small, right? So the most recent price is going to have the largest weight, the largest chunk of the total price. As compared to n being very big. So n is, let's say, 200, day 200. That day 200 price is going to be just a tiny drop in a very big market. In a sense, this is going to be a very tiny price change compared to the main exponential moving function. So we see that, hey, you know what, this approximation of 2 divided by n plus 1 is actually quite a good way to do it. So we have set up the smoothing factor, or the smoothing factor for exponential moving average. Now, remember the formula has this very difficult way to do negative infinity, right? And then when we talk about some approximation of 2p. Now, we can do 2p, but then the question is, where do I start building my exponential function? Because the exponential moving average must from somewhere, right? There must be a starting point, the first ever point in the market that is going to consider as the exponential moving average value. And this is where we need to establish this first value, which is called a seed value, right? So that we can build our future exponential moving average on top of the first value that we have given, right? So typically we use the simple moving average as the first seed value, since we we are not able to go back all the way to negative infinity, right? So we need to establish, okay, where's the first value is going to appear, and that's our seed value, and from there we are going to keep on doing bootstrapping, meaning keep on using that value to create more and more exponential moving average points to form a curve, right? Exponential moving average curve. So this method of determining a seed value is this concept called a recursive mathematic method, right? Why it's called a recursive is that by establishing the first exponential moving average function or value, what are you assuming? You're assuming that this exponential moving average value has incorporated negative infinity values of exponential moving average. Now, let me repeat this, right? So if you have determined a seed value of an exponential moving average, the first value ever, this value will have made an underlying assumption that it has incorporated all the other negative infinity of exponential moving average, right? Because remember, every time when you do a new exponential moving average, it's just adding one more, right? One more value, one additional value, right? So it's always going one step ahead, right? What does this mean? Let me just show you this again. So remember that we started off 3 days like this, right? So one chunk here. Then the next chunk is here, right? Next chunk here. Then the next chunk what? Is going to be something here like this, right? The next chunk is going to be something like this. So it keep on going like one chunk, one chunk, one chunk, one chunk by one day, one day, one day, one day, right? So it's in the same sense, right? So long as you have the first value, then you can keep on compounding it down and down and down, right? So forming the seed value becomes very important to determine your, or to do this recursive method, mathematical method, to allow you to determine the negative infinity value of your exponential moving average. Now, having determined your seed value and you have the price today, then you just, remember I showed you one chunk, one chunk, one chunk, then you just add the price today times your smoothing factor and your seed value, which the exponential moving average yesterday, times the k minus 1, which is just the smoothing factor, not today, but then of k minus 1, right? And this will give you 12. So this is the 4-day exponential moving average. Now, this is a bit weird, right? It's a bit strange. This is the value 12 for exponential moving average. But remember, what did we calculate for simple moving average? The simple moving average, 4-day simple moving average is also 12, right? And remember, when we talk about exponential moving average, what's the difference? The exponential moving average is going to hug the curve closer. But in this 12, which is simple, versus exponential 12, how come it's exactly the same? It's not hugging, it's not closer to the actual value. So then the question is, what's actual value, right? Remember, what are we calculating? The actual value for day 4 is 13, right? Remember what we're comparing, right? So hopefully you're not lost in all these mathematics. But what you're calculating here is this. You have the simple moving average, you have the maybe exponential moving average, which is very smooth. And we are comparing this to the actual price movement, right? So the in day four, the actual price movement is $13. The simple moving average is $12. And the exponential is also $12. But this doesn't make so much sense because why? Exponential is supposed to be closer to the actual price of 13. However, the reason why it does not work the case is because there is interesting price jump and stabilization which happen, which result in the exponential moving average to be exactly the same as the simple moving average. Do we have any worries? Do you need me to repeat? Okay. So what we have done here in this example, we have changed a complex summation, exponential function into something a bit more simple, right? A bit more easy to use on your calculator. So for those who are taking the CFA, I know a couple of y'all have the CFA scholarship, right, from the school. You know that you need to know how to do this calculation, right? Because in CFA, you're using a financial calculator, pen and paper, so you need to know how to calculate this kind of exponential moving average, right? Fortunately, for the purpose of this course, and you probably already know this because you look at your ECA, this is not going to be tested. Hmm. Let's look at something also quite interesting next. What is this Bollinger Band? So a Bollinger Band, right, is very interesting, where you actually see a band created, right, based on a central line. So let's think about the big picture again, right? What's the idea of this Bollinger Band? So we have a nice simple moving average, right? Moving, moving, moving. Now, we want to create two distance from this central line, which is a simple moving average. Then the question is, okay, why want to create like a boundary? So what the idea behind this is we want to create a boundary that captures as much of the price movement as possible. And then the question is, what kind of boundary are we going to use? So in this case, we're going to use the two standard deviation boundary, where having this boundary would capture, assuming normal distribution, 95% of your price movement. So what does this mean? It means that within the boundary, so I'm just going to flip over to the page here to use this nice graph. That means within the boundary here, so I'm just going to zoom in, within the boundary here and here, this boundary is going to capture 95% of your price movement. What does this mean logically? Anyone would like to give it a try? What does this mean logically in your own words? If it captures 95%, what does it mean if the price moves above or beyond these boundaries? A breakup, you're right. So there's a breakup. And depending on what kind of breakup, whether is it breaking up from the top or breaking up from the bottom, it's going to be a drastic big breakup, right? So this is what this Bollinger Band is trying to do. We're going to use the two standard deviation, which captures 95% of price movement, and therefore we do not really use a fixed like 5%. We use standard deviation because it changes with new data, right? And you created a boundary, and then we determine from there when the breakup will happen, right? So in this sense, let's go to point two first. It's about breakup, right? When we see the price cutting to the upper band, it could mean a breakup, or it could also strongly indicate that it's going to mean revert. It's going to go back down to the simple moving average, right? So if the breakup is sustained, then it's a true breakup. But then if it's just almost touching, and then it's like very close to touching, but it doesn't cut, means that chances are it's going to go back down, right? So there's going to be some mean reversion over time. Okay, which then goes to the idea of reversion principle, where if it goes too expensive to the upper band, you'll go back down, or too low, you'll go back up. Okay, now let's go to relative strength index. So what's this relative strength index? So relative strength index measures the speed and change of price movement. And how we measure speed and change? So we use a scale of 0 to 100. So we compare the magnitude of the recent gain and the recent loss to determine how much of the actual asset price is being overextended. Right. So we'll look at the formula in a bit, and this might make more sense. Right. But the idea behind it is that anything more than 80 means that a downward correction is going to happen because it rises too much. If it's less than 20, a reversion might happen because it falls or it fell too quickly. So next question is, how do we calculate this relative strength? So relative strength, we need to first determine the price difference, right? The strength is what's the price difference. So we calculate what is the price change, the price change from one period to the other, right? So it's just basically today's price minus yesterday's price, tomorrow's price minus today's price, right? Difference in price change. Now, to determine the strength, we need to calculate what is the average of the positive, average of the negative. Remember, it's absolute value of the negative. And by determining this, we can calculate the strength of it, right? By using this formula where 1 divided by 1 plus u minus d, I take 1 minus the entire chunk. Right? Just to take note that if d is very small, because d is the denominator, usually you put a small value instead of 0 because you cannot divide something by 0. So let's look at this example here. So we have a 3 days relative strength index, right? So this 3 days relative strength index has the given price. Okay, so not 3 days relative strength index. We are going to try and calculate 3 days relative strength index using the price given to you, right? So you have $100, 105, 102, 110. Now, the change in price from 100 to 105 is 5, which is what we calculated here. 105, 102 is minus 3, and 102 to 110 is plus 8. Okay, so we have calculated change. Now we calculate the average gain. So we see that there are two gains, 5 plus 8. So 5 plus 8, but divide by 3, because this is a 3 days RSI, or relative strength index. Now, we take the absolute value of the loss, divide by 3 again, because 3 is the relative strength index, 3 days relative strength index. And then we have the U, we have the D, we can just plug in the values based on the formula and we get 81, right? And anything that's beyond 80 gives you a overbought situation where the price is likely to fall. Okay. Now, before we go to KD stochastic, do we have any questions? No? Okay, let's go to KD stochastic. So KD stochastic is this, I mean, it looks a bit scary, but it's not very scary, right? The idea behind this is that we want to find a range of price. So within this period, is the maximum and what's the minimum value of your stock, which gives you a range. Now, then you have your price now, right? So you want to determine your price now and where in this range is your price now. So if let's say this is the range, right? Your price now is closer to this side of the range, meaning the top side. We know that there's some tension, that means you're closer to the top. Or if it's the bottom, it's closer to the bottom, right? So we want to determine where, in which part of the current price is, in which part of the range is your current price in. So you are determining the current price relative to the range, the high-low range. That gives you your past stochastic, which is percentage K. We call it short percentage K. Then we have the percentage D, which is the slow stochastic, which basically means you just want to calculate the P period moving average of percentage K. Okay, this looks very scary. We'll look at example in a bit. And you just realize it's just moving average. So basically, if we have, instead of previously using the closing price and calculating moving averages, now what we do, we use the percentage K as the individual points and we calculate the P period moving average of the percentage K. Okay, so the logic behind this is what? As the price gets closer and closer to the high, right? There's going to be accumulation of this price and this tension there. So there could be a chance where the price might fall or the price will cut out of that high point. So in your calculation of your K first, right? Because your K gives you a value. Your calculation of K, this gives you the similar relative strength index kind of formulation where 80 is overbought, meaning the price will fall, and less than 20 is oversold, right? So it's the same concept, right? Here, the K and the relative strength index kind of the same. Okay. And then the calculation of your let me just see whether we should talk about this. See. Okay, so this, okay, we can look at this uh, K. So this line is the K function, right? Or RSI, very similar, stochastic RSI. So the idea behind this curve, what does this mean is that there are 2 points here, right? 80 and 20. So anything that is beyond 80 is going to be a likely price decrease, right? Anything that is below, there's going to be a price increase later, right? However, if you look at the graph carefully, right, there are some periods where it doesn't really make so much sense. So let's just look at here, right? Can you see here? This is above 80, which signals an overbought situation. However, at this point in time, can you see the price has increased? It's a bit weird here, right? So this, why I point out this anomaly is to show you that, you know what, maybe sometimes when we think about technical analysis, we are learning individual silos, right? But you need to put into practice a combination approach. Okay. So now let's look at the calculation. So how do we calculate percentage K? So percentage K is just about having the range, and then we calculate where is our current price relative to the range, right? So let's say we have a high point of 110, we have a low point of 100. So the range is that. What is the current price now compared to the low point? The current price now is 108, is 8. Now we can calculate our percentage K, which is given by just 8 divided by the range times 100, which is 80, showing you an overbought situation. Now, the KD indicator includes the percentage D. And remember what's the percentage D? Percentage D is the P period simple moving average, right? So the P period simple moving average, which uses percentage K as the data point. So remember your simple moving average used the closing price. So now we're using the percentage K price or percentage K values, right? So your percentage K is 70, let's assume 75 and 80, right? So again, I hope you can appreciate what is a moving average again. A moving average is just the average, but then you find multiple moving averages to show how the average moves, right? So I hope to make it simple for you. So it's not some fancy term, right? What's a moving average? So then what do we do in this case? to calculate the percentage D, we just take the percentage K, three values of percentage K divided by 3 because we're calculating the 3 period percentage K here. Sure, 3 period percentage D. Now, there was a percentage D for day 6. Then we just take the average of this, right? We just take divide by 3. So your percentage D for day 6 is 75. Now, this is only one point. So you need to calculate multiple percentage D, percentage D, percentage D, percentage D, and then you can draw a nice curve, right? And once you can draw a nice curve, that's where you can use your percentage K and percentage D lines to determine where is the overbought or where is the worst situation. So when the percentage K line cross above, yeah, above the percentage D, this is overbought. Where it cross from below, it's a overbought situation. Questions? So if it crosses over the overbought line, right? Normally there's going to be some mean reversion. There's going to revert back to a mean, right? Unless for whatever reason it is a very abnormal situation, right? So uh the oil price now, right? It's very abnormal. It's keep going up, 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 up. So then it can actually go for a long period because this is going to be affected by geopolitical news and things that's happening in the world, right? So really, then it becomes really dependent on how long the war happens, right? So it can actually last for a long time. And of course, during these kind of periods of shock, that's where sometimes your analysis doesn't uh, take into account your historical trend, right? Because these are more black swan events. They do not consider more historical trends and the historical price movement, right? Okay, maybe the last one we're going to look at is this concept of MACD, right? So what's MACD? So again, we are going to go back to the concept of moving averages, right? In this time, exponential moving averages. And the idea of MACD is basically I want to try to determine the momentum. So we're trying to determine is a momentum indicator, right? We're trying to determine how the exponential moving average converges or diverges, right? Which is why it's called MACD. The moving average convergence or divergence. And we use the concept of a short, which is fast, or longer term exponential moving average. So short meaning 8 days, long term is 17 days, right? And then we take the difference between them to determine the MACD line. So this is going to call the MACD line. Then we have this more signal line, which is typically the 9 days exponential moving average. Now, in this sense, we're having two lines again. So there's two lines moving. So when the trigger, when the MACD line crosses above the signal line, that means the MACD cross above, go up, the signals a buy. When it cross below, the signals a sell. Okay. So we have an example here for you. Look, let's just zoom in here. So we have the MACD line. So first we have the signal line. So where's the signal line? Signal line is here, right? So this is signal line. And we typically have this histogram. Sorry, there's this point of histogram at the last part. So we typically have a histogram to help visualize the distance that's happening. So again, if you go to your Mumu app or your uh, Tiger Brokers, you will see this exact same, right, with the histogram. So that basically what it's trying to do here, the histogram tells you the distance between the MACD line, MACD signal line, sorry, and the MACD line, right? So it tells you the signal line versus the MACD line. And can you see that at this point here, there's zero difference. And then as the point go up, there's more and more different space, right? And so remember the concept is that if the MACD line crosses the signal line from below, then that is a bull top, right? If it crosses from the top, that's the bear signal. So this is our last, say, technical um, indicator. So I would say that no, if you recall way back in lecture one, I did mention something along the lines that hey, you know what, in this semester we have included a bit more information about technical analysis, which is feedback from students that they want to kind of understand more, right? So what we covered so far, this more calculations, more understanding of the MACD, exponential moving average was actually not really covered previously. It was very light. Um, but now we cover, hopefully give you a deeper appreciation of this kind of technical analysis methods. So previously we just talked about these patterns, right? And I would say these technical indicators are used more than these patterns. And we'll see this reason a bit, right? So what's a pattern? So the idea of a pattern, right, is this. The pattern is just like, oh, is there some like reversal when you spot this pattern, or is there some continuation when you spot this pattern? So there's just looking at the thing and determining by the pattern. So might not be very scientific, but some people claim that it works. The most common one that you see is this support and resistance. So if you go and look at oil prices, right, there seems to be some level around 110, and then beyond 110, right, you see the oil price keep going up, but then it keep going down again. It doesn't breach the 130, 140, 150 price range. So there seems to be some ceiling, right? There's going to be some resistance that prevents the price to keep on going up. So that's one way to see about this resistance. Uh, Now, and in this sense, at that high point, the selling pressure is going to be strong enough to overcome the buying pressure, right? When you keep selling, the price is going to fall. So it overcomes the buying pressure. On the other hand, there's going to be a support happening, right? So what's the support? Basically, a support is when the price keeps going lower and lower, and it just stuck there. It doesn't keep, can't just go lower after that, right? One good example is if you're following quantum computer, so I think it's QUBT, right? QUBT stocks now. You will see that these QUBT stocks, while at one period of time is going up like crazy, it has, because of AI, it has somehow keep on going down, and then now it's just like hovering, can't go down even further. And this is the same reason of a resistance, sorry, a support, where the buying interest, once it goes so low, people are like, okay, you know what, I'm going to buy now, right? Will overcome this selling pressure. So this is a typical example of a support and resistance. And the support and resistance give you a good indication that if, for whatever reason, that the support is being breached, right? It's broken here. It has breached the support. What will happen here in this case is that there's going to be in this sense, a bearish sell signal because it has breached the support, meaning that it's going to continue going down, like going down, down, down. And once this happens, your support now becomes the new resistance. Okay, so that's quite common. Now we have this more, I would say, less used kind of method called the continuation patterns, right? And then we start drawing random shapes, okay, not really random shapes, but shapes like triangles, etc., right? And we have this thing called the ascending triangle. And so ascending triangle is what? Ascending triangle is where the bottom is sloping up, but then you have a sloping up bottom and a flat top. So the triangle is ascending upwards. And so this tells you that the price will continue to keep increasing upwards. Ascending triangle is a bull signal compared to a descending triangle where you see a flat bottom. So there's going to be a flat bottom and a top that is slanting down, right? So the idea behind these two triangles is that based on the price movement that you see, price chart, you try to draw small little triangles here and there to determine where is your ascending, where's a descending triangle, and then from there predict how the price will continue to move up, right? So this is a continuation pattern, meaning that if you determine a descending triangle, the price will keep on descending and keep going down. We have also symmetrical triangle. So symmetrical triangle means that it's going to be very uncommitted, right? Up and down, up and down, up and down, of equal distance, and eventually it's going to just shoot up or shoot down, right? And if we shoot up, there is a bull. If we shoot down, it's a bear. Okay. Another continuation pattern is this thing called a flag or pennant. So a pennant, okay, so a flag first, right? A flag literally looks like a flag pole with the flag that is on the top. And the idea behind a flag is that there's going to be an interesting increase here, but then it's going to go down, right? So there's going to be this thing where it's going to decrease a bit. It's going to slant downwards before shooting up again, right? So if you see like an increase and then there's this small little going downwards trend, this is your bull flag. On the other hand, if you see that the flag is going down all the way, and then after that it goes up for a short while, and then it goes down again. This, in this sense, is a bear flag. So what you're trying to do now is that hopefully at this point in time, you can tell that this is going to be a bull flag, and then you buy a lot here, right? And then you see the price shoot up like crazy. And hopefully at this point of time, you can at this point you determine that, hey, you know what, this is a bear flag, and you sell before it plunges downwards. So that's the idea, because you want to determine the pattern before it springs up or springs down. Okay. The tennis, similar to a flag, but then it's a bit more uncommitted in the sense that there's going to be a symmetrical triangle, meaning that it's going to be a bit unsure, like it's like very unsure. And then suddenly it's just going to shoot up or fall down, right? So this is a continuation pattern of pattern. So in terms of volume, it generally contracts during the pause. Pause meaning that it's just going to be flat like this, and then there's going to be an increase when there's a breakout. Okay. Now, so those are continuation patterns. We do have some reversal patterns as well. So reversal patterns means that once it make this pattern, it is going to reverse course, then go down already. So we have this thing called double top. The double top is basically forming a M shape, right? So hopefully you can see two tops here, two peaks. And after forming this M, it's going to go down, 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 there, where this is a neckline, right? It's like a neckline here. Sorry. Then we have the reverse, which is double bottom. The double bottom is almost like a W. So double bottom like this. Then after this is going to go up, 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 up. So this is more of a bullish signal. Okay. We do have a triple top. So, if you notice that patterns, right, it's really whatever people think about, right? Again, I like to repeat that, trading strategy is really personal, right? You form this kind of, triple top, double top, you form a quadruple top as well. It really depends on how you use this strategy, right? So somebody come with triple top. After a triple top, it's going to reverse, right? Where they notice like historically that, oh, you know what? The volume of the highest pick one and it's going to be lowest at pick three. And so when you notice this kind of pattern, oh, there's a three top, but then the highest at pick one and lowest at pick three, then it's going to be means that after that the price is going to fall like crazy, right? So that's where you should quickly sell at pick three. So that's what people use to determine the reversal pattern. The next reversal pattern is this concept called head and shoulder. So head and shoulder again, it's a bit complex, right? Oh, you got a left head, a left shoulder, right shoulder, head and neckline. But the idea behind this, right, is that if you look at this slide, is that there's going to be some ups, right? And on the left side, it's going to be the left shoulder. And then it's going to be go some down, and then go up again, which creates a hit, and then go down. So, and then after that, it goes up and down, right? And it's a reversal pattern, meaning that after you form this like mountain, like up, down, up, down, up, down, this mountain shape thing, after that, you're just going to break away, right? It's just after it's going to break away and go downwards. So it keeps going down from here. Sorry. Then it keeps going down from here. Now, then the question is, oh, okay, when it's not when I see this random pattern appearing, right? There must be some volume related. Remember when we first started the lecture, we talked about how volume is very important, right? And kind of ask that question as well. So this is where we need to see where the volume is happening. So in the left shoulder, there's going to be high volume in the first rally, right, to the top, followed by a reduced volume as you go down and during the rise. Again, you go in high volume at the top, and then less volume as it nears the bottom. So there's going to be some volume changes, which then we need to look, we need to see in comparison the price change to determine whether it is a head and shoulder pattern. Last but not least, the neckline basically just shows you the low point in the left shoulder and the low point of the right shoulder. And connecting the right to the left, that is your neckline. Any questions? Do you have any queries? Okay, maybe no questions for now. Okay, so this is just a head and shoulder. So let's think about the summary of what we have covered today, right? So today our focus is really on technical analysis. Not imagine, but the last four lectures that we're talking about is about fundamental analysis, right? And the idea of fundamental analysis is what? It's about finding valuing a stock, right? We want to value, oh, is it overvalued? Is it undervalued, right? But today, just today, what we're covering is thinking about price changes, right? Which is why we think about patterns, which is why we did the RSI, moving averages, right? We're calculating the price change and then how we draw lines and moving lines, whether it's close to the trend line, etc. Right? We're really focusing on price change. And in technical analysis, remember we mentioned how volume is plays a very important role, right? Because volume implies that the market is convicted in terms of price movement. And it means also like what some of you all say that it has price, it has big magnitude. When there's high volume trades, there's big magnitude. Then in terms of risk, for fundamental analysis, it's all about return on equity, return on WACC, RE, return on equity, right? Fundamental analysis, how you make money, you want to sell an overvalued stock, buy undervalued stock. For technical analysis, on the other hand, what we're interested in is the price movement, right? We're going to make money only when there's price movement. So actually, volatility is very good, right? If you decide that, MSCI is going to be very low now, you're going to capitalize on this, going to buy MSCI stock, right? Or similarly, for those who are interested in or actually and investing in crypto, you notice that the last couple of days, the crypto winter has, some people say, defrost, right? It's no longer a crypto winter. So those of you who are very interested in crypto, you know that for the last months, crypto has been like going down, 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 right? And it's only this week that it started climbing, and it's climbed quite significantly. Notwithstanding it yesterday, it fell again, right? But it did be a good climb. So some people say that, you know what, this crypto winter is defrosting. Uh, I believe today is also Iranian Spring, right? Iranian New Year, and normally Iranian New Year. So not, I don't think we have any Iranian here, but Iranian New Year typically signals fresh beginnings, new start to the year. Like how, if you celebrate Chinese New Year is a new start. So Iranian New Year usually signals uh fresh start, right? Which is perhaps why the stock price decide, or not stock price, but the crypto price decides to go up now instead of keep going down in the winter. Fundamental analysis, longer period, analysis, shorter. Type of information, technical analysis, we are just looking at price and volume, right? Versus fundamental, which we are focusing on the economy, the company, we're looking at financial statement, we're doing ratio analysis, one whole long list of analysis that we do. Now, the idea behind fundamental analysis, the issue is that we need to make a lot of assumptions. Remember what we talk about, hopefully, in your GPA or even your ECA that we're going to do soon, is that you're going to justify why you do this, right? Why you choose a risk period of 10 years, not 5 years, right? You need to really justify all your answers because the justification gives you the reason behind your value. And remember what we discussed also about having a critical lens to take a step back, right? After doing your valuation, did you comment on how well you do your valuation, right? Remember, I emphasize how important that is to take a step back to do a litmus test on your value, right? When you get a value of $40 per share, you don't stop there, right? You don't say, "Oh, I'm so happy I get a $40," but do you think it's good enough in terms of your valuation compared to what other people say, right? So assumptions, justification, very important for fundamental analysis. But in technical analysis, no, it's totally different, right? It's just choosing which chart, using which technical indicators to determine your price movement. And that's about it, right? A bit more simpler in that sense. Okay. So I still see a question. How do we determine the best technical analysis strategy during a volatile period such as oil, crisis? Oh, very good question. So sometimes, right, there's this thing called event-based investments, right? So event-based investment technique is when there is a black swan event, a crisis, right? That's the point in time we buy stocks that have fallen, right? We buy stocks that have fallen. So, for example, in this oil crisis, right, we do see a lot of, um, we do see actually quite a bit of the AI stocks being very low, right? Because oil price is very high, the market is really focusing on oil. Maybe recession might be near because the prices are too high. So oil prices, AI stocks are actually relatively low, right? So maybe a good time to buy, right? So this, it could be event-based kind of strategy during actually volatile period. Um, Not only that, but sometimes, there's this, not sometimes, but there was this period where, do you remember the crowd crowd strike outage? You, have you all heard of this? The crowd strike outage is where the cloud server crashed and then the airplanes couldn't fly. Yes, it affected import. Yeah, so maybe some of y'all were affected as y'all were traveling, right? Yeah, you're right, 2 years ago. So those are event-based also. So at that point of time, because it was a one company thing, which was very strange, right? There was no contingency, no backup. So one company, once that company cloud server got flew away or like disappeared, the cloud disappeared, everything stopped, right? So if at a point of time you because of that big issue, the price obviously fall like crazy. If you buy a stock, event-based kind of investment, you have make a lot of money right now, right? At least 50 to 100% of your investments, right? Based on 2 years ago. So maybe to your question, uh, what's the best technical analysis during volatile periods? Uh, a bit tough for me to say, because it's a strategy that you have to find out yourself. But I would say that, maybe it's not about the technical analysis, but maybe it's about picking the right stocks for volatile period, right? We know that even during volatile period, things like gold has been going up, right? Even though there's some pullback recently, gold has on the whole went upwards because of the safe haven trade. So maybe gold is a good place to park your money during volatile periods, right? However, of course, if you're interested in trading, you'll probably you can dig more and find out more. You know that you can do a long short strategy as well, right? Long short strategy in volatile period, which is very good in terms of trying to make some money out of volatility. And so a long short strategy does what? You buy S&P 500, right? And then you buy an ETF that shorts S&P 500. You put $500 there in S&P, $500 in short S&P 500, which is an ETF. So it's not you're not actually shorting it. You are just buying ETF that shorts it, right? So when it's volatile, it's going to move in up and down, right? So when the price moves up, your S&P 500 will go up. Obviously, your short goes down, right? Then you sell your S&P 500 up, right? You make the profit. Then when S&P 500 go down, then that's where you sell your short, and then when you buy your S&P 500, right? So basically, you're just going to buy and sell your short and long positions, and during volatile period, it's actually quite useful. See a question. What is S&T? Okay, S&T. I'll say definitely technical analysis, sales and trading. So sales and trading, I'm reckoning you're talking about the market floor, right? You are in the market. So yeah, if you're in the market, then technical analysis. Yeah, technical analysis. Because you need to be fast, right? But then again, of course, it depends on what you're selling and what you're buying, right? If you're buying and selling FX, generally technical analysis. If you are doing things like bonds, then it's a different kind of technical analysis because then it's about mathematics, right? It's about calculating your yield, your par value, your yeah, fixed income is a totally different thing, right? So it's not even fundamental, it's not technical. Maybe you can consider technical. So it really depends on what you are tasked to sell and buy. Okay. So maybe I really enjoy the conversation so far. So actually, that's all I have in terms of lecture slides. Um, I think it's a good time to take a break. Let's take another 7 minutes break. We'll come back and then we'll use the remaining time to discuss any questions you might have. So hopefully before you take this time in your break to think about some questions you might have for ECA or your class test, and I'm happy to answer them, right? As usual, of course, I cannot go through the questions, of course, I think most of you are year 2, year 3 students, you know that that's, we can't do that. But what we can do is to answer any queries that you might have, right? So that we are fair to all class. Okay, so let's take a break and then we'll come back in just a bit. All right. Um, Welcome back. Um, so let's use the remaining time to answer any queries, any doubts you might have on the ECA and class test. Um, so I just want to highlight to you that even though we're only on lecture 5 and we have one more lecture to go, you can really start doing your ECA. So do start doing it. I know some of y'all would be more focused on the class test, but really your ECA, is 50% a mark. So try to balance your effort accordingly, right? Um, and do push and focus a bit more on your ECA, right? Okay, so do you have any questions? You can unmute yourself if it's easier, or you can type it in the group chat. Okay, maybe as you think about the questions, right? Let me just make a few general comments, right? So I've received some emails asking whether can you use the same company in your GBA for your ECA, given that the questions are very similar, right? I think some of you email me that. The short answer is yes, but let me just caveat this, or let me just warn you, right? You can actually use the same company, right? And of course, you need to adjust the answer accordingly to the question. But what's important to take note is that you would have already uploaded your GBA in Turnitin, meaning that Turnitin will have data of whatever submission you have. So you will have to ensure that you do not breach the plagiarism score where if you will decide to use the same company, right? You can use AI tools to help you rephrase your answers so that you avoid the plagiarism score, but also just be careful that you do not breach the AI score, right? So I believe some of you all know that there are various methods to not to do it such that you do not breach any of this scope, right? I think some of you are very good at doing it. So um, just be careful if you are trying to use the same company, which would offload your work quite a bit because I know you might want to prioritize other modules, but just be very careful when you do such a thing. The long and short is yes, you can use the same company. There's no one stopping you, right? However, on the other hand, for those who are really striving to get your A mark, right? If you're going to use the same company, you just need to be careful that to see whether your other teammates are using the same company, right? And as you know, because the ECA is not like a take home, it's not like an exam, right? Or where there's a right or wrong answer, right? It's a very broad thing, right? And as all kind of subjective, broad marking kind of assignments, where it's like a project, there is obviously some benchmarking, right? Meaning that you're being compared with relative to some other reports, right? It's a relative basis kind of marking, right? So if you really want to stand out, right, you really score your A, then of course, maybe putting in extra effort to write an investment on a different company might be useful, right? So it really depends. Or maybe improving the answers that you have written for your GBA can actually give you a good mark, right? So you have written a GBA, you have gotten the feedback, which I will try my best to release by the end of the last lecture, right? So of course, sometimes the school they don't want us to release too early because other classes are still haven't released it yet. So if everything goes smoothly, I can release it. We will have a short discussion on the GBA during the last lecture. Any questions? Any queries? Feel free to ask because um, maybe your classmate might have the same query, right? So it is useful to share the queries. Okay, maybe you have not seen the ECA yet. Now, I encourage you to have a look at ECA questions. In the question, right, I'm just going to highlight two general points. There is a presentation and there's a PowerPoint slides that you have to do, right? So there's a report, presentation, and PowerPoint slides. Now, for the PowerPoint slides and the presentation, the marking scheme is given to you. So that is a super big hint to tell you you basically just need to follow what the marking scheme wants you to do. Okay, let me be a bit more specific, right? Hopefully this will help you. Is that for the PowerPoint slides and the presentation, the content is not important. So if you have not seen the ECA, do take some time to look at ECA questions. There is no mark given for content and and content of the in the PowerPoint presentation slides and the presentation, the recording. So really, the marker is going to look at your video and grade you based on the criteria given in your marking scheme. Similarly, for your slides, he or she is going to give you marks based on the criteria stated in the marking scheme for the slides. So the question is super broad. They did not say, okay, you need to do a PowerPoint on point ABC. No, you can talk about anything within the confine of your report that you're going to submit. But what's important is that you need to ensure that you meet the criteria to score the marks. Now, historically, for people that film themselves using a camera, right? A phone camera instead of a laptop, like what I'm doing now, a laptop, right? Like a proper phone camera with good resolution, and stand like not far, but like a distance, right? Like a distance with dressing, like, maybe you wear a suit, right? For ladies, you wear like a nice blouse. Typically, you will have you will be able to achieve higher grades because when you stand a bit of a distance, so not like this, right? Not like you're talking like this, but like with a distance that people can see your hand gestures, they can see your body language and your eye contact, right? The further you are from the camera, it is not so obvious that you might not be staring into a camera, right? So sometimes, so eye contact is one of them, is part of the marking criteria as well. So if you stand further away, your eye contact, people cannot penalize you on not having eye contact. As compared to me, let's say, going so close, and it's normal for us to stare at the screen instead of a small little camera at the top. So thing is, if you stand further away, it's easier for you to achieve your eye contact because it's not so obvious that you're not staring at the camera, right? So these kind of small things, hopefully, for I know for some of you really want to score that A, do put a bit of effort, right? I think putting on a suit, putting on a nice blouse is not going to cost you anything, right? You don't spend 1 hour doing a makeup and all. You just put on something nice, uh, have proper setup, record yourself, you'll do well, right? I want to also emphasize that for the video, you need not have the slides in that video, right? So you can just record yourself like this, right? So imagine I'm not sharing my slides now. You can just record yourself talking. That would be perfect because based on the marking scheme, it's really purely on your presentation. So good question. So in terms of the quality of presentation, it's really about looking at the marking scheme. So marking scheme talks about articulation, the pace, the eye contact, the body language, the gesture. So those are exactly the things that we are looking at, not editing. Yeah, you don't have to do editing. Of course, if you are, I mean, some of you are a part-time YouTuber, you do like nice, not really like movie style editing, but like nice way to cut your video, feel free to do it. Or some of you are doing TikToks, you know how to cut videos quite nicely. Obviously, TikTok video is very different from proper presentation. But if you know how to do those, it's to your own benefit, right? So there's one semester, there's this student of ours. he is actually like a DJ. So he has like the whole DJ mic and like the background and all. He was like he's passionate about DJ, right? So he has that in his own house and he does like podcasts and kind of thing. So then he had the whole setup ready, and he's very familiar with everything, right? With the recording and everything. And obviously because he's so confident, he basically scored full marks for the presentation, right? If because really it's like the way he brought himself out, like speaking like a DJ, with of course the proper mic and all, but those I think is not so important, but it's just the way he presented, he managed to get like 100% for the presentation. Okay, I do see a question here. Let's see. Hi. For one is quite similar to a GB. Understand that one valuation approach is comparing. Okay. Respect to the great. Yeah. So I think there is unfortunately I cannot really go into individual questions where I say you can have a general question, but then I see that the questions relating to PE and EV slash EBITDA. So this is our last lecture, which is lecture 6, where we talk about relative valuation. So hanging there, this is the relative valuation topic. You can skip that question first and do the others. Keep this question for after the last lecture, and then you should be able to tackle this question, right? This question is about relative valuation. And because it's about relative valuation, there's quite a bit to write about. You will notice this in the last lecture, which is why maybe it's 30 marks. Okay, maybe I just talk a bit about slides. Feel free to be keep typing your questions or even unmute yourself if it's easier. So the PowerPoint slides, again, for PowerPoint slides, we are looking at the criterias that the marking guide has provided you, meaning it's about the logical flow, it's about the font, it's about the design. As you know, PowerPoint slides, if you are just going to write, okay, so PowerPoint slides is very, okay, so a proper presentation PowerPoint slides is different from a teaching PowerPoint slides, right? So a teaching PowerPoint slides is like this, very wordy, right? But because we're teaching, so we're trying to put in as much words as possible so that you need not be scribbling, right? So it depends. Some lecturers like to, leave a lot of blanks so that you have to, are forced to write, fill in the blanks, that kind of things, right? But for me, because I know it's an evening class and many of you are working full time. So the additional effort to be writing and scribbling is a lot for an evening, right? So I can't understand that it's not easy, which is why typically my slides include all the information so that you just need to scribble notes that you feel is important and so that you can really focus on the class, right? So having said that, I want to try to emphasize that a teaching slide is very different from a presentation slide, right? So hopefully you understand that if you're going to write so much words like what you see here in these PowerPoint slides, you're not going to get a good grade for your slides. Having said that, nowadays there are a lot of AI tools that allow you to just throw in your report as it generate a PowerPoint slides. Feel free to use it to the extent that you're not detected for the AI score, right? So I know a couple of friends that use it for the teaching. So they teach for a full time, right? Where they actually throw in textbooks into this AI program to generate slides for them. And then because the AI generates slides in the form of images, which means that it's very obvious, let's say for a marker, that if you see text, right, image, that's very strange, right? If you really did the PowerPoint slide, it will not be text, right? So it actually shows that you just use 100% AI, which is not what obviously the school wants you to do as well. Yes, you can use AI, but then you should do a bit of modification, right? So you can actually pass these AI slides through another program, another AI, to generate actual PowerPoint that is editable, right? When something is editable, it shows that you have actually edited, you know, and hopefully an AI program doesn't pick that up as well. Your AI score is low, feel free to do it, right? So, uh, you know, I think what's nice about SUSS is that we embrace AI technology and encourage you to use it in your assignments, your work. However, with a proper degree, right? So not like just copy and pasting. So yes, you're right. So it's about evaluation approach, core relative evaluation. So we can skip that for the time being. Uh, oh, you can't skip because you determine subsequent. Mm, okay. So okay, try to see, right? See where you can skip. See where you can't skip. You can still do your presentation and um facts, right? So nothing is going to stop you. So you can do your presentation and slides about the economic environment of the industry, right? Which you have chosen, right? You do something about that, and that one you don't need to do any evaluation, right? So I think I received some questions. So in terms of the presentation, do I need to cover every single question in the ECA? No, right? Your presentation again and your PowerPoint, it has no content marks. So let's say you're confident about talking about the economy, right? And it's part of your industry analysis. You can just do a presentation of industry analysis of the firm, obviously, you choose, right? So if let's say you choose a healthcare company, then you try to do a industry analysis of airlines, then a bit doesn't make sense, but you'll not lose any marks, but it's just like, why you do like that? So do something a bit more relevant. So if you're doing healthcare stocks, yeah, do an industry analysis of healthcare stocks. You can do your recording, you can do your PowerPoint slides ahead, like now. I see a question, class test. Yes, so it's lecture one and two, but I want to emphasize this again, uh, in case you might have forgotten, is that lecture two is an overview of lecture three and four. So really, you need to also look at lecture three and four. Okay, so just be careful. If not, if you just purely look at lecture two, you'll find that there's first of all not many practice questions for lecture two, and the practice questions for the concepts in lecture two is actually covered in lecture three and four. So you might want to do a bit of practice if you do have some time uh, before the class test, and those practice can be found in lecture three and four. Okay, any further questions? Do a bit more. I'm seeing people are dropping off, right? I think it's also because it's a Hari Raya. Maybe some of y'all might even be traveling. Any final questions before maybe we call it an early night, and so that your Muslim friends can also celebrate. Okay. Uh, okay. So that's up to you. Uh, it is so I know for a fact that some groups have chosen banking sector. In case you have and you have done it in your GBA, it actually and you feel that you did well, it actually can be not too difficult, right? So uh, if you read more about banking sector, I think most of the time the valuation is based on DDM, basically equity count valuation, right? Because you're not so concerned about the debt holders. So it could be a bit easier. Uh, Depends on you, right? Really depends. Of course, if you ask me, I would say if you want to just value a very simple company like what in the case that we have the Spandex case, it's just a manufacturing company, right? It's a lot simpler, but nothing stops you from doing a banking industry. Okay, then maybe just some quick reminders. Remember to log in to your class test on time. At the same time, for your reports or ECA, just be very careful of AI score and plagiarism because the thing about take-home assignment like this, right, ECA, is that the school is very strict about this score because they know it's a take-home assignment, right? Plagiarism can be quite easy to do, right? And AI score can be quite easy. So if you use things like Grammarly, where they help you alter your grammar or help you improve your grammar, those sometimes can be captured as AI as well. So I think we have a case where 90% of the report was flagged as AI, and then only subsequently realizing that the particular student used Grammarly, right? So for that time, lucky for student, he was given a waiver. They say like, okay, this is the last time, we know that you just use for grammar, but it's not, it's still being flagged, right? So just be very careful. For ECA, is very strict. Okay, I think we're losing more people. Any final questions before we call it a night? So again, I know many of you have also started emailing me. Feel free to continue to do so. If you have questions, I'll try my best to answer them. Of course, hopefully understand that it cannot be, especially for ECA, it cannot be very specific ECA questions to be fair to everyone. So it cannot be like, oh, how do I should I do this method or that method, right? So unfortunately, won't be able to answer those kind. But if it's a general question, feel free to ask them. Okay, all right. So maybe that's all for now. Again, thank you for coming for today's class. I know it's a long weekend, so hope you have a good rest. All the best for your class test next week. Um, Hopefully, I will be able to release your GPA results by the last lesson. And yeah, I will see you in the last lesson. So, it's time flies, right? We were just talking about the first lesson uh, almost about a month ago, and now we are approaching the last. So have a good night. We will talk again. Feel free to drop me an email if you do have any questions. Okay, let me pause the recording.